At the start of 2026, U.S. equities look calm on the surface and bears are not out of control. But what the market is really trading is not the earnings cycle, it is uncertainty itself. When geopolitical events and liquidity expectations enter pricing at the same time, the market no longer moves in a linear logic, but through a relayering of risk appetite. Hello everyone, I'm Peter. Today is January 6th, 2026. I'll put the conclusion first. The market right now is not answering the question, is it expensive? It's answering, do you dare? When capital starts pricing uncertainty itself rather than paying for certainty, the price action you see will inevitably conflict with traditional fundamental analysis. Taking the Venezuela event as an example, the market's reaction has actually been very restrained and very rational. Capital is not trading whether oil will be tight in the short term. Instead, it is recalculating a much larger equation, how control over energy resources may change over the next several years, and what level of risk premium is required to hedge that uncertainty. That is exactly why energy-related assets reacted sharply, while oil prices themselves did not spiral out of control. So, if you're only watching oil prices, you'll completely miss the point. What the market cares about now is not how much a barrel of oil is worth, but who gets a seat in the future energy order. Once the logic shifts to that level, strength in the Dow becomes easy to understand because it carries expectations tied more closely to real assets and geopolitical certainty. From a broader rhythm perspective, U.S. equities have clearly moved away from a fundamental-centered pricing phase and entered a zone dominated by sentiment and capital behavior. Indices grind higher, small caps stay active, and the January effect continues to ferment. In this environment, valuation reasonableness becomes far less important, replaced by a single question: is money still flowing in? But the biggest trap in this type of market is that it makes people misjudge their own ability. You'll notice that even sloppy trades can make money, which leads to relaxed standards and expanded position sizes. The real risk is not that the market suddenly ends, it's that you abandon risk management when the market feels smoothest. The recovery and risk appetite is not limited to equities. Crypto assets are resonating with risk assets in this phase. After Bitcoin broke through key levels, sentiment repaired quickly, and crypto-related stocks became the most direct amplifiers. But this reflects a warming of capital sentiment, not confirmation that the long-term structure has been re-established. That's why trading crypto-related assets right now is more about following emotion than betting on trend. The higher the beta, the more eye-catching the upside when sentiment improves, but once the wind shifts, the speed of adjustment can be just as overwhelming. If you treat this kind of market as a conviction-level opportunity, both your position size and expectations can quickly enter dangerous territory. At the same time, gold has not been abandoned by the market. It continues to be allocated. This point is critical. It shows that capital has not fully accepted that risk has disappeared, but is participating in risk assets while simultaneously buying insurance against potential uncertainty. Risk assets and safe haven assets rising together is itself a form of pricing future uncertainty. This state is actually more concerning than one-sided risk aversion, because it means market sentiment is split, optimistic on the surface, defensive underneath. As long as this structure exists, you cannot treat the current market as a low-risk tailwind. It's more like a balancing act under high volatility. What may truly change the market's rhythm is not the news itself, but the macro data about to be released, especially this week's non-farm payrolls report. It will directly affect how the market judges the liquidity path. If the data weakens, easing expectations, the January effect could cool quickly. If it continues to support the soft landing narrative, sentiment still has room to extend. So from this point on, what you really need to focus on is no longer what the headlines say, but how the market digests the information. It's not whether the jobs report is good or strong, it's how rates move, how the dollar reacts, and whether risk assets can continue to hold up afterward. What this reveals is the market's true attitude toward the liquidity environment. Within the AI sector, structural changes are becoming increasingly clear. It's not that AI demand has suddenly disappeared, but that first-tier core chip stocks, after sustained rallies, are clearly losing acceleration. Prices no longer advance in a one-way move. instead showing frequent gap-ups followed by sell-offs and failed breakouts. Meanwhile, memory, second to tier, and even peripheral names begin to rally in clusters. This is a very typical capital behavior signal. The greatest danger at this stage is that it looks like opportunities are everywhere. It feels like everything is going up, as if not buying means missing out. In reality, the market is extracting the final layer of sentiment premium. The real issue isn't whether you can make money, it's whether you can clearly distinguish what is the core trend and what is merely emotional catch-up. From an overall rhythm perspective, the market is now in a phase with the strongest sense of participation, but also the fastest accumulation of risk. Price advances look effortless, pullbacks are quickly repaired, but that does not mean risk is declining. On the contrary, the more the market feels like it can't go down, the easier it is for capital to lower its guard and further stack positions. So a more realistic response is to first understand where you currently stand. If you're already in the trade, this is the phase where you should think less about squeezing extra gains and more about turning existing profits into a safety buffer. If you're not in, there's even less reason to let emotion force your hand. Watching market breadth and crowding becomes especially important at this stage. What you need to observe isn't just whether indexes are making new highs, but how many stocks are participating. If indexes rise, but advancing stocks fail to expand, capital remains highly concentrated. If gains spread rapidly to many high beta names, it signals that risk appetite is spilling outward. This is exactly why, at this stage, a trader's perspective is more appropriate than an investor's perspective. This rally is not built on long-term, stable fundamental consensus. It is built on rapid risk appetite repair and sentiment-driven capital flows. The mature approach is to align your holding period with the nature of the market itself. Structurally, the market is extremely sensitive to liquidity expectations right now. Energy, crypto, small caps, and high beta tech may look independent, but they are all tied to the same variable underneath, whether financial conditions remain accommodative. Once the market begins reassessing the rate path, the first assets to react will be those with the highest elasticity. So what truly needs to be guarded against is never how much it has gone up, but a change in market attitude. When bad news is no longer ignored, when pullbacks stop getting bought immediately, when volatility expands without repair, that's when sentiment support is loosening. At that point, the most important action is not proving whether you're right, but reducing risk first. In this environment, participating in stages is far more realistic than making a one-shot directional bet. Advance, consolidate, then advance again is a more likely rhythm than a straight line. That means every rally consumes future space, while every pullback is a repricing for the next leg. Truly mature trading isn't about capturing the maximum of every move, it's about ensuring you always have an exit. When markets are smoothest, discipline matters most, because the market rewards careless behavior and convinces you that risk no longer exists. By the time risk truly shows up, adjustment space is often gone. From a sector structure perspective, different assets are playing very different roles in the current environment. Some lean toward certainty, some toward emotional elasticity, and others sit in a transition zone where consensus is beginning to loosen. If you ignore these differences and apply a single logic to all assets, the result is usually amplified volatility, not higher win rates. If you break it down carefully, you'll find this: chasing certainty assets costs time, holding emotional assets through volatility costs capital, and core assets where consensus is fracturing costs psychological endurance. The most reasonable approach is to let your position structure itself reflect your risk assessment in advance, rather than reacting only after problems surface. As time goes on, the stimulus from events will inevitably fade, while macro data and liquidity conditions will ultimately reclaim pricing power. Headlines can ignite emotion, but only data determines how far that emotion can run. That's why, the closer we get to midweek and beyond, the market's tolerance for error will clearly decline. So what you truly need to do now is not increase trading frequency, but prepare scenario paths in advance. If the market continues, what is your scaling plan? If it weakens, what is your exit order? As long as these two paths are clear in your mind, you won't panic when real change arrives. Taken together, 2026 is clearly not a year where a single directional bet leads to easy wins. Geopolitics, liquidity expectations, and sentiment rotation will take turns dominating. Volatility itself will become the norm. Anyone who treats this year as a pure trend year is more likely to get repeatedly humbled. If you're still imagining that one correct directional bet will solve everything, the market will likely remind you of reality through repeated swings. The people best suited for this year are those who can execute repeatedly under uncertainty and still control risk when emotions are hottest. I'm Peter. If you're interested in my work, I'd appreciate a subscription.